You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Pretty solid start to the market. Got some green on the screen. The S&P up about 0.1%, a little bit similar movement in NASDAQ as well. Looking down at the crude oil, we've been following that. It's been moving higher. It's up another 0.5% today, $76.18 a barrel there for WTI crude oil. Yields are pretty steady. You got your 10-year Treasury yielding about 3.77%. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Paul, another legal case against former President Donald Trump has not gone his way. A federal judge in New York has rejected Trump's bid to toss the $5 million jury award for E. Jean Carroll, the magazine columnist who accused then private citizen Trump of sexually assaulting her in the Bergdorf Goodman in 1990s and then defamation when he called her a liar. This comes a day after Trump said he is the target of special counsel Jack Smith's 2020 election investigation. By the time all said and done, former President Donald Trump could have a half dozen cases running against him, his family, and his businesses, while the 2024 campaign is in full swing. Brown University political scientist Wendy Schiller says all this might not be on the average voter's radar, though.
Americans are now looking at the idea of recession. Maybe it's not going to happen. Maybe gas prices are a little bit less. Maybe inflation's coming down. We're looking at inflation coming down. They're looking about the day-to-day and the economy, and they're not yet really focused on 2024.
Brown University's Wendy Schiller spoke on Bloomberg Surveillance. In Ukraine, Russia's been pouring out intense overnight attacks in the southern city of Odessa with drones and missiles. Ukrainian President Vladimir Zelensky is accusing Russia of deliberately targeting port infrastructure after pulling out of the grain deal. South Africa says Russian President Vladimir Putin will not be attending next month's BRICS Leaders Summit in person. That puts to rest a question about whether South Africa would execute an international criminal court warrant for Putin's arrest. Another college is ending legacy admissions after the Supreme Court's decision to end race as a factor in enrollment decisions. The New York Times reports Wesleyan University in Connecticut is joining MIT, Johns Hopkins, Carnegie Mellon, and other highly selective schools in ending preferential treatment for children of alumni. Powerball's back on, and there are a billion reasons to play.
We're ready. We already have the financial advisors ready.
That woman in Chino Hills, California, is lined up for tonight's billion-dollar jackpot, and Mega Millions isn't that far behind. That top prize is up to $720 million because nobody won last night's Mega Millions draw. So now we have two multi-state lotteries with two mega jackpots. Odds of winning it all, 1 in 302.6 million. But which number are you focused on? Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg, Paul and Madison.
So you're saying I still have a chance? I mean,
there it is.
There you go. That's all
Can't
you need.
win if you don't play, Paul Sweeney.
Nathan Hager, thank you so much. We appreciate it. Here's another story, Madison, of another celebrity creating a business that gets huge valuations. What's our friend Kim Kardashian up to?
4 times over unicorn status here. Skims raising $270 million in a new funding round, valuing the company at $4 billion. And for some context here, for those who aren't avid Skims shoppers,
yes. Underwear brand?
An apparel brand. They sell swimwear, underwear, shapewear, which is what they were originally most known for. And as our incredible producer Eric Malo pointed out recently, the shapewear was credited with saving the life of a woman who was shot because of the amount of pressure that it applies, because it really sucks you in, Paul. So it's very effective.
It's like a tourniquet.
It's very effective. And that's one of the reasons why it's valued so highly here. And also, I should mention that Kim launched a skincare brand that was bought out by Coty for $1 billion last year. So she's really raking it in.
Business person. I mean, this funding round has some real investors. Wellington Management Group is in there. Green Oaks Capital Partners in there. So some real names. And she's raised a total of $670 million for this company alone. So, and again, as Madison was just saying, at a $4 billion valuation. So good for her. Again, another celebrity creating a business, selling it, making real money. So good to see there. All right, coming up, we're going to have more on these markets. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to be busy. We're going to get the latest on the markets with Bloomberg's equities reporter, Jess Menton. She's going to join us here and give us the update. Plus, a little car talk for you. David Welch, Detroit bureau chief for Bloomberg News. He's going to talk about Carvana, stock ripping on a debt restructuring. We got Tesla results after the close as well, so we'll get a little preview there. And then we're going to talk, see what's going on in the M&A market. Very quiet. We heard those kind of comments from the Goldman Sachs and the Morgan Stanleys of the world. Rob Brown, CEO at Lincoln International. He runs the M&A biz there. He's going to be in our studio here a little bit later this hour. We're going to get the outlook for the M&A space. But right now, let's kick it all off with a Bloomberg Business Flash from John Tucker.
All right, the major averages adding to yesterday's gains, and looks like cooling inflation giving the markets a boost. The latest data, this is out of the UK this morning, shows that maybe rates have peaked. So can the rally continue? Victoria Fernandez at Crossmark Global Investments does see a number of red flags for investors.
We have been a much more cautious, I'd say, than the market has been itself. Leading economic indicators down 14 months in a row. You look at the inverted yield curve and the starting to see it steepen a little bit. That's actually your signal historically of recession coming.
Right now, the S&P 500, 11 points higher. That's up 0.25% at 45.66. The Dow Jones Industrial Average up 142 points. That's a rise of 0.4%. The Nasdaq 100, 26 points higher. That is up 0.2%. You're going to have more on this coming up, but Carvana, the used car dealer, a big debt pile. They've made a deal to restructure that debt. Also, they beat revenue expectations. That is among the most active, 37% higher right now. Leading the way in terms of index points for the S&P 500, Amazon.com, and Tesla, which, as you mentioned, Paul, reports results after the close of regular trading in New York today. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Madison and Paul.
All right, John Tucker, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in the Bloomberg Interactive Brokers studio. We're streaming live on YouTube. Go check it out and just Google and search. When you get to YouTube, search Bloomberg Global News, and you'll find our feed there. So how good is that? Let's take a look at these markets. S&P up about 0.25% off of its intraday high, but still moving higher. We'll take it. Let's see what's happening under the hood with some of the names. And we check in with Jess Menton. She's Bloomberg's equities reporter. She joins us here in our Bloomberg studio. Jess, what are you looking at?
So looking at the S&P 500, it's on track for its 7th positive session in 8, and also it's within 5% of its all-time high that was last reached on January 3rd of 2022. So still continuing that strong rebound from the October lows. Also wanted to point out, when you're looking at the Dow, which obviously at times can get overlooked when we're talking about the S&P 500 and the NASDAQ 100, it did have 7 consecutive days of gains, and so that was its longest winning streak in more than 2 years. So seeing some more positivity when we're talking about a lot when it comes to industrials as well as small caps over the past month, materials, and obviously transport. So still seeing those more cyclically oriented corners of the market holding up. We've talked so much about banks, but I wanted to actually point out another stock looking at Cinemark. So that's ticker symbol CNK, down right now a little more than 2%, but it did drop close to about 7% this morning. So it did come after JP Morgan did downgrade the movie theater operator to neutral from overweight, and it did say that the visibility into an increasing film supply is limited by the actors' strike. So we do have those two big movies this weekend, right? So Oppenheimer, and then of course the Barbie movie, which we've all been eagerly, I know JT's been eagerly waiting for this. Which, did I really hear that you just found out that Tupac was dead.
Oh,
Is that
Oh my
brought
God,
that up.
Jess,
No,
you really
let me
Is that
explain.
threw
So
him
s-
right under.
I mean, you were giving me a hard time
I
the
was
other day about Tony
concentrating this
Danza,
morning.
who
Right.
I obviously am aware of, and Back to the Future, and being shocked that I would know them, even though I'm closer to 40 than 20. But
Drag him, Jess.
I was
Get it
pretty
going.
upset when I
you.
found out about it
Tupac.
30 years later.
You're a Tupac fan.
Yeah,
so
I'm a
I'm
little
just gonna
behind.
say, and I was also alive when that happened to Tupac. So
Thanks for pointing
All
that
right,
out.
I am going
I
to go
have
see.
nothing to add.
I am going to go see the Oppenheimer movie this weekend.
you thought I forgot about that on Monday.
He died a while ago, J.
Yes.
Robert Oppenheimer.
Yes,
I
he
just
did.
found out about that, too.
Listen,
Well, yeah.
we remember the
I
things
came
that
in
get said in
guns
this
blazing
studio.
on this Wednesday.
I think what we really need to focus on, which John and I have talked about before, is the Barbie movie. And is anyone doing the double feature of Barbie and Oppenheimer? Because that's a thing that people are doing. You're doing Oppenheimer this
doing an
weekend.
Oppenheimer.
I'm doing only Barbie. One of us needs to do both. Someone's in my ear. Elizabeth is saying she's doing both.
Okay, very good.
right.
All right, we'll see.
Well,
You know,
that's
it's a
cool.
big thing for the
I'm probably
the
gonna have to do Barbie because Ryan Gosling,
yes.
Yes, Queen. I know.
There you go.
And Margot. I mean,
And
it's
then you got
gonna
Matt
be
Damon
incredible.
and the other one. It's
He's a director on that one, so I think.
I'm
so.
like, whatever. I know what's going to happen in that one. Anyway, markets.
I will have to see, but it's big for Hollywood. It's big for the theater owners because the Mission Impossible movie came in below expectations. So there's definitely people more than J.P. Morgan are concerned about
Right.
just Hollywood in general, the big media companies, and then the theaters as well. Because
Yeah.
what are you going to do with the writers are on strike, and now the actors are on strike at a time when your business is already under huge pressure from the pivot to streaming. So tough time to be
And
an
a lot
investor in
of
those media
negative
names.
commentary
Yep.
from the actors to Bob Iger
Right.
during these protests after he kind of said that he needed them to get
and
it
Disney.
together.
I mean, that's Paul's heyday.
Sure.
When he was
Oh
an
my
analyst
God,
and when
Paul.
he covered.
So it's
Disney
going to be tough.
DIS.
It's tough, yeah.
Right.
It's
That
gonna be really
stock's
tough.
down more than 20% over the past 5 years, and also flat just for the year. So still struggling when you're looking at that media landscape space, Paul.
Yeah.
Yep. What else are you looking at there in the equity markets?
Yeah, so I actually did today's Taking Stock column. So I was writing about, because we keep talking so much about, obviously, the euphoria and big tech, how long can this continue? So I was looking more at the ETF flows. So this is data from Strategas Securities, Todd Sohn from over there. And so he was looking at how more than $110 billion have flowed into roughly the 2,200 ETFs that track U.S.-listed equity funds over the past 3 months. And to put that into perspective, the peak in 2020 was actually around $240 billion. So you're seeing a lot of flows after going into these U.S. equity funds, but it had been really at a tepid pace at the beginning of this year. So it's showing you that it's really not at the FOMO level quite yet, and it still has more room to run there. And so that's what they're looking at when you're trying to gauge as far as what kind of contrarian indicators and sentiment indicators could be like that, because we've seen obviously the broader equity market do one thing and flows do the opposite. So now you're seeing flows beginning to start to catch up, but they're really not at extremes just yet. So that could kind of signal that we could continue to see more money flowing into some of these big tech names.
And we're still seeing more flows into the equal weighted equity funds you mentioned as well.
So the RSP's taken in more than $6 billion since the beginning of June, and it actually posted a record month last month if you go back over the last 20 years. And what that's telling you, even though we've seen some underperformance with when you're looking at just the equal weight gauge compared to the S&P 500, if you look at the end of May till now, it actually has just slightly outperformed the S&P 500. And when I've been talking to portfolio managers, it's really more geared toward, if you already have this exposure toward large cap names and you're thinking about more cyclical oriented type names, like I was talking about before, whether you have exposure toward kind of industrials or materials, transports like that, that's another method that they're doing. So it's not necessarily like a doom and gloom type thing, and they're not really wanting to bet on these big growth cap stocks. They want to find exposure elsewhere. So here's what they're doing with RSP. So it's going to be interesting to see if we continue to see that money going in. And again, that was more than $6 billion since the beginning of June.
And I'll just call out, I like nice round numbers. The Dow Jones Industrial is now 35,100. So above 35,000, nice little move there.
Yeah.
So we'll see how that plays out. And again, I think one of the themes that a lot of strategists are saying is you got to look for a broadening out of this market in terms of the breadth of this market. And it is happening, but because it's, for the first, 4 or 5 months, it was strictly those big names, it seemed like.
And now you're seeing it, small caps, transports, materials.
All right, great stuff. Jess Menton, we're not. She's going to go be a Barbie person this weekend, presumably. We'll see how that plays
Talk
out.
about Tupac with John Tucker.
Yeah, we'll do a little Tupac.
You got that Barbie look going there, Jess. That's a good look. That's a good look.
Okay.
All right, Jess Mann covering the equities for Bloomberg News, joining us in this studio here. Let's talk a little car talk here because there's a lot going on. We've got Carvana is kind of the story here today, but Tesla very well might be the story after the close. Let's bring in David Welch, Detroit bureau chief for Bloomberg News, joining us via this Zoom thing. All right, let's start with Carvana. It seems like they've kind of fixed a lot of their problems here, David, in terms of their balance sheet, both by getting a restructuring and then maybe pushing some more equity on the balance sheet. Is the worst behind this company?
I don't think so. I think they have a long road ahead. They've restructured the debt, and so they should be able to reduce debt by more than $1 billion. They're going to issue equity, which could help them pay off more debt. But they're still, right now, they're carrying $8 billion. So there's a long way to go to really get that debt down to a more manageable level. And they'll be cutting interest payments by quite a bit this year, but if you kind of throw it all together, they have such a big debt load. It's going to take them time to work that down, and they're going to be trying to do this in the face of a softening used car market. Prices have already come down a fair bit, so there are some very good signs here, but there's still a lot of work ahead for Carvana.
Well, and that road ahead has already been great. We just have a story on the terminal from Esha Day from our equities team talking about how Carvana's surge hits 1,100% this year as investors are reaching for that risk. What do you make of the surge in the stock price, and is there more room to grow in the second half of the year?
Well, so look at the history of the stock. It was at one point it was over 300. So when it's now right around 50. That's a big fall from where it was, and it's been far cheaper than where it is today, obviously. So this is a stock that's going to have probably some more wild swings to it. I think if they continue to show progress, turning the operations down, reducing costs, and they can get to a point, which is management's goal, where they can start growing the business again, there could be more upside in the stock, sure. But again, they've got these other issues. Right now, I think investors are just happy that this company has managed to actually put its operating plan into place and start to make some progress with it.
David, give us a sense. You mentioned kind of the weakness in the used car market. Just give us a little bit more color there. What's going on with the used car market? Because from what I understand, Detroit is kind of out of the business of making 17.5 million cars, and maybe the number's more like 15. What does that mean for the used car market?
So the used car market has benefited hugely from the fact that new car production was cut so much over the past few years due to the semiconductor shortage. Now we've got chips coming back. We've been selling cars at a rate of over 15 million. It was actually second quarter was more like 16 million.
Okay.
So we're not getting back to the 17 plus numbers, but we're getting back to the numbers where if people want to find a new car, they can. Whereas the past couple of years, they often couldn't find what they wanted. So they would have to go to the used market to find something. And that's that prices were insane in the used car market. There were used cars selling for more than a similarly equipped new car.
Right.
It got so out of hand. Those days are over, and prices are they're still like relatively pretty strong, but they've come down from where they were. It's softening up. I think last I saw, it was down about 10% this year. So it's not cratering, but it's softening. And if you sell used cars, that means the stuff you bought a few months ago, you're having a tough time maybe keeping the profit margins that you were enjoying a quarter ago or a year ago.
So sorry to cut you off there. I just wanted to say that profit margins are also going to be the key thing that we're focused on when it comes to Tesla earnings later today, as you know. What can we be anticipating, and what is going to be your single biggest question when it comes to Tesla earnings?
So people are kind of expecting that they're going to have a pretty strong quarter, even though they have been cutting prices for a lot of this year, but you sort of saw their price cuts level off in the quarter. Sales have been pretty strong, so I think financially speaking, most people are expecting the results to be pretty good. I think investors will be looking at things like the Cybertruck coming out soon. What's the progress update on that? What's production going to look like? Any updates on pricing and how that's going to play in the market will play pretty big because we saw Ford just cut prices up the F-150 Lightning, its electric pickup truck. in anticipation of competition from Tesla. So I think a lot of eyes will be on what's going to happen with that vehicle. It's huge for them because they haven't had a new vehicle since the Model 3 and Model Y launched a couple of years ago, and the Model S and the Model X are kind of long in the tooth. So they really do need this vehicle to, they're still growing, but it's not quite the growth story it was a couple of years ago.
Right.
And something like a driver truck would really energize that.
Well, right. And one of the headwinds for them is the lack of charging stations and just the infrastructure surrounding that. Do you anticipate a lot of questions about that on the call?
I think, honestly, at this point, the issue of charging is almost more of a question for the other companies who are getting on Tesla's network. Okay. But there will be some questions there. I think one big one is as you basically invite other companies' customers onto your charging network, which I think long term is a good thing for Tesla. But near term, do you start crowding up your own chargers and annoying your own customers? I think there's a concern out there, and that question may come up. Tesla will get revenue from this. It's not going to be a huge bonanza, but there's an estimate out there that they could get another $3 billion in revenue by the end of the decade from customers of other car companies. It's not a high margin business charging, but it's still business that they wouldn't have gotten otherwise. Yeah. So, there may be questions too about guidance on that. At the end of the day, the whole thing on charging is really, it's an issue for every company. They've got to build the network out, particularly on the highways, to get people to feel comfortable buying electric vehicles.
David, you're based in Detroit, so when you're out at the local watering hole and you're sitting down with your car buddies, what do they really think about transitioning to electric vehicles? Is it good for the industry, good for everybody?
It's very polarizing at this point, honestly. I got friends who are just dying to get an EV, and every time a new one comes out, they ask me, what do you know about the Mercedes EQE? What do you know about this? What do you know about that? And then there are other people like, I don't know about this. I don't want to have to charge someplace. What if I take a road trip and they're nowhere near there?
Yep.
So it's captured the imagination of a large group of people, but others, until they see charging stations at every truck stop and service area and rest area along the main highways for their road trips, they're not going to do it.
Right. Yeah. Interesting. David Welch, as always, giving us the latest on Detroit, on the big automakers, and that includes Tesla. Tesla reporting results after the close. Always closely watch. David Welch, Detroit bureau chief, Bloomberg News. Talk about a company town out there in Detroit with the autos. So, having a team out there covering that industry right from Detroit just gives you the local color that you need. But again, Tesla, after the close, stocks had a nice rally here. We still got some room to go to get back to that 52-week high, but it's had just ripped this year as some of the tech names have come back into favor. So we'll keep an eye on that. Overall, the market's looking darn solid here. We have S&P 500 up 0.4%, the NASDAQ up just about 5%. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, Goldman Sachs investors can't say they weren't warned. The bank's grim forecast for the second quarter came to fruition with earnings down 58%. It's one of the worst quarters for the bank under CEO David Solomon.
There's more M&A dialogue. I can't tell you exactly what the journey is. We're making tough decisions that are driving the strategic evolution of the firm. Given both these factors, it should come as no surprise that we're going through a period of lower results.
Solomon
I remain fully confident that we will deliver on our through-the-cycle targets of mid-teens returns and create significant value for shareholders.
Solomon, on a call with analysts, says the other side of the cycle will continue to look attractive. Shares of Netflix are up more than 0.5% as investors prepare for the streamer to release second quarter results. That's coming up after the bell. Bloomberg's Charlie Pellet reports.
Investors will be looking closely to see how the company's recent crackdown on password sharing is impacting the business. The company has been asking subscribers who share their account with others outside their home to pay extra to maintain their access. Analysts believe the move will lead to a bump in subscribers and a rise in revenue per customer. At Bloomberg Intelligence, analysts also say the password-sharing crackdown and a new ad-supported tier will begin to bear fruit this quarter.
Thanks, Charlie. And U.S. mortgage rates fell back below 7% last week, largely erasing the week's surge the prior week. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets after this.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Green on the screen today. Signs of cooling inflation in the UK, of all places. That's carrying over to boost risk assets here in the U.S. So the idea is maybe we've reached peak rates across the globe. In the S&P 500, you have 9 of the 11 major industry groups higher right now, real estate leading the way. Also, AT&T rising after the company reassured investors. They say less than 10% of its nationwide copper wire telecom network had lead-clad cables. Right now, that's among the best performing individual stocks in the S&P 500. S&P 500 up 16 points. That's a rise of 0.3%. Right now, 4570 on the index. The Dow Jones Industrial Average up 143 points. That is a rise of 0.4%. And the Nasdaq 100 61 points higher. That is a 0.4%. The rate story right now, the 2-year yield down 1 basis point. That's at 4.75. 10 years pretty much unchanged. That's at 3.77. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Madison and Paul.
All right, JT, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. We've been hearing from a lot of the big banks over the last 4 or 5 days talking about their business net interest income positive, but certainly offset by a lack of deal making for a lot of these companies. The comparisons are very tough. We want to get a sense of what's happening in the M&A space. We talked to Rob Brown. He's the CEO of Lincoln International. He joins us here live in the Bloomberg Interactive Broker Studio. They're based in Chicago, one of my favorite towns anywhere. Rob, thanks for joining us here. Talk to us about kind of the M&A environment we're seeing out there now. A lot of uncertainty about the economy, and that historically doesn't really bode well for boards and CEOs getting out there and putting big capital to work. What are you seeing in your practice?
I think what you just alluded to, Paul, is what we've seen really over the last 8 months to a year, right? The economic uncertainty really slowing down the M&A market, and you're seeing it in the release of some of the big banks and even Goldman's release today, and the investment banking business being down. So I think that's what we've seen. Interestingly, there's some alchemy right now for improved activity, and I think there's really 4 factors that are driving that. I think one is if you go back to how we came into the year, there seems to be more consensus of a soft landing, or at least not a really hard landing. And I think there was always that fear of investors saying, well, I don't want to put something to work and have the bottom fall out of the economy. So I think the backdrop is we may have a recession, but it's probably not going to be as severe as I thought. I think the other key input here is that as each quarter has gone by, since probably mid-year last year when you saw inflation spike and the Fed respond aggressively, you're seeing sellers' expectations moderate down a bit. Okay. So, 2021 and the first half of 2022 were really peak valuations. So I think as time has gone on, sellers are starting to realize I may not be able to sell it for exactly what I could, but I can still get a good return. So, and I think the two last pieces are we are seeing the aperture of the private credit markets improve a bit. The credit markets are actually hardening up in a good way, and that lenders are saying, I will finance this deal. It's going to be expensive, right? Rates are high, but they're going to be there. And the last, and maybe the biggest driver, is the amount of dry powder sitting in institutional equity holders, in private equity, venture capital, and even the private debt funds. It's starting to burn a hole in the pocket of investors. And on top of that, they're under pressure to show some returns and return some capital to raise the next fund. So I think all of that kind of pointing, maybe not up hugely, but starting to trend in the right direction. I think we're expecting much better activity for the back half of the year than the first half.
Well, Paul and I talk about this all the time, just that it's a challenging environment to get deals done in. I'm curious how your conversations and strategies have shifted, if at all, given some of the hawkishness that we've seen from the FTC, from the Justice Department when it comes to M&A deals.
Well, there's no doubt about that. I mean, we're all trying to wait and see what comes out of the new proposed FTC rules for Hart-Scott-Rodino and clearance, and we're in a comment period on that, and I know our industry is commenting aggressively to, we understand, listen, these rules haven't been changed in 40 or 50 years. It's okay to revisit them, but, I think they need to be done in a way that's going to achieve the objective. So there is worry about that. But I think your point is right. Deals are harder to get done. I think what we're seeing is more targeted processes, making sure you have financing lined up before you approach anybody, and really going to investors with a pretty compelling investment thesis that says, listen, we know you, we know what you like to acquire. Here's why you really need to look at this. But it's more challenging to get things done, right? You got to get the financing in place. I think the leverage has shifted a bit to the buyers in terms of dictating the due diligence schedules and dictating what they need to get done. But we are seeing things get done. They're taking longer. They're a little more painful, but they're getting done.
Talk to us about the role of private credit, because that's kind of a relatively new business. And Madison and I, we spent a lot of time talking about, we try to speak to as many smart people as we can about the private credit business, because really it's really just became a big source of capital after the financial crisis. How does that factor into your deals? You typically do more middle market transactions. How does that factor into your deal?
It factors in massively.
Okay.
Most of our deals, particularly if we're selling to a financial sponsor, a private equity group, or an institutional investor, a good chunk of our deals are going to need leverage to get done. And the entire market for that is the private credit market. I mean, the banks have, the compliance issues coming out of the global financial crisis. The banks are out of this market. So now you're dealing with private credit funds, hedge funds, unitranche investors, and that market has attracted a tremendous amount of capital over the last decade. And they have a lot of dry powder too, but that market really closing up a bit in the back half of the last year, as much as the fear of the economy downturning, is what really casts a little bit of a pall over our market. So what happens in that market is a really important driver of the overall private capital markets and the deals that get done on the private market.
Did some of the banking turmoil have any impact on you guys via the impact on private credit?
Not really. I think, particularly if you look at SVB, there was a little bit of a shock as to what does that mean. But they were really in the venture debt market, and so the short answer is not really. Although one thing I will say that's interesting is our European M&A business, and we have offices in 16 countries, 20 offices. We've got a lot of offices in Europe. It's a big part of our business. That M&A market is actually holding up better than the U.S. M&A market this year. Partly because there still is a bank lending market in some of the major economies to get deals done, where we don't have that here. So they've been able to look through some of the private credit markets, pulling their horns in. I think they also have a situation where in the UK, the largest capital market in Europe. They're worried about a Labour government next year and cap gains rates going up. So there's a little bit of a push to get things done now.
But more regulation in the UK
Definitely,
than ever as well.
definitely. I think the regulation headwinds are going to be everywhere.
Okay.
You guys are a lot bigger than I thought you were. I'm just reading some reporting. You guys did it recently. Got into Australia, India. You said you're in 16 countries. I'm seeing some reporting here. 850 investment bankers. Why aren't you guys public?
We have followed our public our public competitors, right? There's clearly an appetite for what we do. I think for us, we have a pretty clearly stated goal to be the leading advisor in the private capital markets. And to date, we've felt that being a private partnership is the right way to do that. But we're constantly evaluating, should we have a different ownership structure and access to broader capital? So it's something we haven't ruled out, and I think we've made some investments to be public company ready if and when we determine that's the right thing to do.
What is the biggest benefit for you staying private then?
For us, I think the thing we need to balance, that what's made us unique and what's allowed us to grow from 7 of us to one of the largest private markets M&A advisors in the world has been a real focus on culture that attracts people and keeps people for the long term. And we've been able to define that, measure against it, manage to it as a private company without having to worry about what's going on in every single quarter. And if we were to go public, we'd want to make sure that we can continue to really have that as the oxygen of everything we do. And I think part of it's just different, right? We kind of know, the governance, we know how this works. But I think organizations, if they're going to evolve, if they're going to continue to grow, have to continually reevaluate, what's the right capital structure and ownership structure to achieve our goals.
So India, for example, a lot of folks are saying India over the next 20 years is going to be it's going to be China was the last 20 years, maybe, for example, but better. How do you guys view it?
Yeah, I agree with that statement. We have been in India a long time. We've been in India over a decade. We are about to announce in the very near term here an acquisition in India that's going to materially increase our presence there. And we also have offices in China. As we're seeing those offices slow down, as we're seeing the economic ties really cool with China, we think that the biggest benefactor of that is going to be India. India is the largest democracy on the planet. Their law is based on English common law. It's much easier to do business there. And it's a really, really innovative economy. So we're very bullish on what we're seeing in India right now and really doubling down in that market.
And conversely, 20 seconds left, China.
Yeah, I don't see in the near term any sort of warming up of the economic ties with China. I think that it's very difficult to get a Chinese investor clear. We were talking about compliance. Trying to sell something to a Chinese buyer today in any Western country, very, very hard.
Yeah, interesting. All right, Rob, thanks so much for joining us. Fascinating company, which I need to learn more about. Rob Brown, CEO of Lincoln International. They're based in the great city of Chicago, but as Rob was just saying, these guys are all over, and they focus on middle market M&A, which, as we've learned from a lot of people like Rob, a very lucrative business, competitive business, but very lucrative business. And so we'd like to pay attention to that as well. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Paul, a day after former President Donald Trump said he is a target of the Justice Department's 2020 investigation, another legal case has gone against him, and it's one he wanted. A federal judge in New York has rejected Trump's bid to toss the $5 million damages for E. Jean Carroll, the magazine columnist who had accused him of sexual assault in the 1990s, then sued him for defamation. Judge says Trump's claims that award was excessive were, quote, entirely unpersuasive. Russia says it will now consider all ships headed to Ukrainian ports as potential carriers of military cargo starting tomorrow. Kremlin's defense ministry announced that on Telegram after a night of massive drone and rocket attacks in the southern Odessa region. Ukrainian President Volodymyr Zelensky has accused Russia of deliberately targeting port infrastructure after ending the Black Sea grain export deal. Wheat prices jumped about 9% on that warning from Russia. Former Secretary of State John Kerry has been in Beijing the last 3 days with a focus on climate change. Now, the White House Special Climate Envoy says he needs more time for talks.
We came here to break new ground, which we think is important at this stage, and it is clear that we are going to need a little more work to be able to complete that task, which we still believe, both of us, is doable.
Climate envoy Kerry says the talks will continue with China on an accelerated schedule with a focus on renewable power and addressing other greenhouse gases besides carbon dioxide. Wesleyan University is joining a select group of colleges that are ending preferential admissions for children of alumni. The liberal arts school in Connecticut says it is a response to last month's Supreme Court decision effectively ending affirmative action. Wesleyan President Michael Roth put out a statement saying legacy admissions have only played a negligible role for years, but now they're making it formal. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages all higher right now. Let's get a little love to the Dow Jones Industrial Average. Despite being home to Goldman Sachs, the Dow appears poised to extend its winning streak to the 8th consecutive day. That actually would be the longest streak in years for the Dow Jones Industrial Average. Giving a lift to risk sentiment today, the idea that rates may have peaked. Neil Dudd at Renaissance Macro Research says for now, the U.S. economy not too hot and not too cold.
I'm sort of in the Goldilocks for now camp. I mean, I do think that there are reasons to be somewhat suspicious about how long this can last, about whether this is a durable, sort of sustainable moderation in inflation. I think that's a question that needs to be answered. I don't think we can answer it just yet.
And then Tesla's going to report after the close of regular trading in New York today. Investors want to know how a series of price cuts for their models cut into margins there. The stock up 142% since the start of the year. Adjusted earnings per share estimate 81 cents. Streaming giant Netflix also reporting after the close, so the expectations also high there. A crackdown on password sharing may have led to a jump in subscriptions. Not in my living room. S&P 500 up 17 points. That's up 0.4%, 45.72. The Dow 156 points higher, 34,107 on that index. And the S&P, the Nasdaq right now, Nasdaq 161 points higher. That's up 0.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Maddie and Paul.
All right, John Tucker, thank you so much. We appreciate that. As always, Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. We are streaming video on YouTube. Just go to YouTube and search Bloomberg Global News. Tom Ogner, Senior Portfolio Manager, Managing Director at Allspring Global Investments, joins us. But Madison, Tom and I go way back. There was a time when I used to peddle radio stocks to Tom and Ann Maletti when they were at Strong Capital Management. I'm not sure if Tom remembers, but they were buying those radio stocks back in the day, and those things were ripping. The best performing stock in the 1990s was a company called Clear Channel Communications. So I know Tom remembers that. Tom, good to see you, bud. You're still...
Hey, thanks, Paul.
And you're still... See, and this goes back to another thing I say, Tom. Pound for pound, I think some of the smartest investors are in Milwaukee, Wisconsin. I don't know what it is. Maybe it's that University of Wisconsin thing going. I don't know. Tom, what do you guys, you and Ann Maletti and the other PMs there at Allspring, what are you guys doing in this market these days? I mean, we had a good, really good first half of the year after a brutal 2022. How are you guys playing for the second half?
Yeah, well, I think like everyone, we're watching the macro a bit, but, also the other indicators. And, one of the things I've tried to do over, my career is watch what's going on in the bond market to try and get some reads over the equity market. And I'll tell you, it's not been a good read over the last year or so. It's been wrong in predicting when the Fed's going to cut. It's had, credit spreads have been tight relative to history. And so it hasn't been the best predictor. But if you still look at it, it's, this kind of Goldilocks scenario that you guys have been talking about does seem to be what the bond market's actually predicting. So I'm not surprised that the equity markets have rallied on that. I think two things. One, you got to look at probably at this point, the market at some point here needs to broaden out, right? It's just been so mega cap dominated. And if you look at valuations relative to historical valuations, whether it's in growth, which I play in, or in value, the large cap premium is very, very high by historic standards. So small mid cap stocks trade at about 10 to 20% of their valuation relative to history, relative to large cap stocks. And I think that's one of the things investors should think about in diversifying their portfolios.
Well, we're starting to see a little bit of that. We're seeing flows into the equal-weighted S&P ETFs expanding a little bit, as well as the Russell 2000 breaking through a key technical level this week. When you are looking at small caps and those growth stocks, like you mentioned, what are you looking at to determine some of the long-term growth and gains that you may be able to get that could be competitive with these Magnificent Seven stocks?
Well, I think first thing you need to look at is valuation and balance sheets. And so looking at, how they're structured, can they finance their growth? What is the expense going to look like in this higher interest rate environment? And, for us, that's pretty key. We call it kind of sustainable growth going forward. And so, controlling your destiny on the financing side, on the capital structure side, I think is very important. And then where are you situated relative to the economy, right? And to be fair, competing with some of these mega caps companies is pretty difficult. Right. And so, what niche do you have that you can bring to the table that Microsoft or an Apple isn't going to chip away at? And so those are, I'd say, the two key areas that we're looking at. What niche, and then how does your capital structure look like, and how can you finance your future growth?
Tom, let's talk some names here. A couple of names that you have. One is Boston Scientific. What's your call there on that medical device company?
Yeah, it's one we've liked for a while. What we like about it is you've got pent-up demand. And so you look at, we've been calling it the COVID hangover. So you had the COVID effect, and really for the last year or two, you've had this kind of COVID hangover of various sectors. On the positive side, you've seen travel and like restaurant part of the economy, service part of the economy do really well. But then you've seen a decrease in spending, right, for hard goods and other areas. And what we've seen within the healthcare sector is it wasn't huge, but because of COVID, we think actual utilization started to go down, in particular for procedures. And so companies that are tied to, like a Boston Scientific, tied to cardiovascular or tied to what they call med surge or even urology surgeries are starting to see some uptick in those volumes. And we think there's probably a 2 or 3 year opportunity there where you continue to see upticks in volumes. Plus, they've got a lot of new products coming to the market. And so within all that, we think it's pretty well situated for, again, this tailwind, we think, of people who put off surgeries, put off going in and even getting diagnosed during the COVID crisis and even the aftermath of the COVID crisis. You're starting to see that reverse, and you've seen that in Q1 volumes. We expect it in Q2, and I actually think it's got a multi-year leg to it.
Well, I got to ask you about Shoals Technologies Group, particularly ahead of Tesla earnings coming out later today. What do you think about their ability to get in on the EV charging space, and how does that play into your calculation on that name?
Yeah, I mean, Shoals is definitely a more speculative stock. So it's down the market cap. It's still developing markets. Their main market today is utility grade solar and doing electronic pre-situated electronic solutions, electrical solutions for those utility grade. But the big growth opportunity, to your point, is potentially EV charging. Right. And they actually participate, whether it's one of the two standards. It looks like Tesla's standard might be the winner after the recent Ford and GM announcement to go with that standard, even though actually, if you read the IRA Act, it looks like the stimulus dollars there are going to the historical standard. But it doesn't matter to Shoals. We think they have a play there. It's a similar solution. What they do is allow pre-manufactured electrical solutions to be kind of plug and played much more easily into whether it's solar installations or these new EV charging. And I think, we're all in agreement. We need a lot more EV charging. I think the market is going the EV way, and what's holding it up, the regulator right now, is more EV charging.
Tom, we're never getting you out of Milwaukee, are we?
I hope not, especially this time of year. It couldn't be more beautiful at this point.
All right, Tom. Hey, it's good to see you again. Tom Ogner, thanks for your time. Tom is a senior portfolio manager, managing director at Allspring Global Investments, co-worker with my good buddy Ann Maletti. So again, some real strong people there. They started this firm, back in the day, Strong Capital Management, Dick Strong, huge money management firm, mutual fund, employed a lot of really smart analysts who have stayed in Milwaukee and gone on to other things. So
what he just said, that charging stations are the regulator for EVs, that is my favorite buzz sentence about electric vehicles, and I'm stealing that for every conversation I have about Tesla. So
very good.
Great chat with Tom.
Yep, absolutely. S&P 500 up 0.4% here. Same for the NASDAQ, up about 0.4%. Again, the Russell up a little bit better, 0.6%. Yields kind of steady here today. 10-year Treasury 3.78% to 2-year 4.78%. So still 100 basis points of inversion. We're going to have more coming up. This is Bloomberg. get some company news right now with Steve Rappaport.
Paul, Carvana shares soar after the company reported a strong second quarter and reached a debt restructuring deal. More on that from Bloomberg's Katie Greifeld.
Carvana actually spooked Wall Street last night when it announced that it was going to move up its earnings release by several weeks, but turns out it was to announce pretty good news. Quarterly earnings beat forecast, and the reason why you're seeing shares up is the agreement with the bondholders. It's going to eliminate about 83% of Carvana's 2025 and 2027 unsecured notes. All told, Carvana expects to reduce its debt load outstanding by more than $1.2 billion.
Thanks, Katie. Shares of Carvana currently up more than 30%. The bosses may want everyone back in the office, but it turns out the biggest holdouts are some of their best performers and executives. Bloomberg's Joan Doniger reports.
The Wall Street Journal reports McKinsey surveyed 13,000 office workers in 6 countries and found the largest share of those who strongly prefer to work from home make more than $150,000 a year. They're the ones who say they'd probably quit if they were called back to the office 5 days a week.
Thanks, Joan. Paul, what's for lunch today?
Well, I'm eating some peanuts at the moment.
All right. Well, what about a hot dog?
Love it.
Well, it's National Hot Dog Day, so this is the day for you to celebrate. I'll get to the deals in a second, but check this out. The Hot Dog and Sausage Council, yes, this is a real group, says how much was spent on supermarket hot dogs in 2022. How much?
A lot.
All right, about $8 billion. Quick on the deals, you can get 25% off Ballpark at Target, a free hot dog deal at Doghouse, and Nathan's Hot Dogs for 5 cents. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio, taking a look at these markets up about 0.4% on the S&P 500. We're going to have Tesla reporting after the close. That's going to be really front and center for the market. The stock is up 1.2% today. It's up 141% year to date. So a nice move off of a brutal, obviously, 2022 for that and a lot of other tech names. It's got a market cap here. Where are we now? $940 billion. So not too bad for the supporters of Tesla. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
That's almost Powerball numbers.
Exactly.
Well, the legal pressure continues to mount up against former President Donald Trump, but one case that he wanted to happen won't. A federal judge in New York has ordered Trump to pay E. Jean Carroll $5 million for sexual assault and defamation. The former president had asked for a new trial against the one-time magazine columnist, claiming those damages were excessive, but U.S. District Judge Lewis Kaplan called Trump's argument, quote, entirely unpersuasive. This comes in the middle of a presidential campaign that all the Republicans are trying to find their breakout moments in, with the former president continuing to hold a vice grip on the GOP base. That includes former New Jersey Governor Chris Christie. Bloomberg's Anne-Marie Hordern has more on where things stand for him.
He's really obviously wants to have this lane where he is one of the few that really goes directly after the former president. We know that about him, but I think it's also important to make sure we're getting his take on a number of important issues that you would ask any presidential candidate.
And Bloomberg's Anne-Marie Hordern plans to do just that, along with Joe Matthew. Former New Jersey Governor Chris Christie is going to be a guest this afternoon on their show, Bloomberg's Balance of Power. Tune in for that interview on Bloomberg Radio and Television. We'll have it for you at 5 p.m. Wall Street time. A bill to reauthorize the Federal Aviation Administration is up for debate on Capitol Hill right now. And it's not just flight crews and air traffic controllers paying attention. As Bloomberg's Amy Morris reports, so are pro sports leagues.
The NFL, MLB, NCAA, and NASCAR are raising concerns about the FAA reauthorization bill, saying it reverses federal law prohibiting aircraft from flying over sporting events, restrictions that have been in place since 9/11. Punchbowl News reports Transportation Committee Chair Sam Graves is a pilot, and it's his amendment loosening that rule. The House is moving forward with the language already in the bill, so the leagues will likely have to take their argument to the Senate when they take it up. In Washington, I'm Amy Morris, Bloomberg Radio.
Don't sleep on the subway price hikes. The Metropolitan Transportation Authority, New York City's transit agency, is expected to vote today on raising base fares for rail and bus from $2.75 to $2.90. New York Times reports it would be the first fare hike for the New York City subway in 8 years. MTA has been resisting this move because they lost so many riders after the pandemic, but now the MTA board says it needs to balance the budget. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington, where subway fare increases are like a dime a dozen. This is Bloomberg. Paul and Madison.
All right, Nathan Hager, thank you so much. We appreciate it. Still the most efficient way to get around this island is the New York City subway. I'm a huge proponent. All right, Netflix after the close, Madison. Revenue drivers for this company are including get rid of the account sharing and then introduce an advertising tier. That's what analysts are counting on. But there's a lot going on in terms of price changes, right?
Well, I think this is so interesting ahead of their earnings, announcing to CNBC, Netflix gets rid of their cheapest basic ad-free option both in the US and the UK. So they did have a basic plan for $9.99 that didn't feature ads. That plan is now gone. So the cheapest option is $6.99. You're going to have to watch the ads if you do that plan. And then if you want an ad-free experience, you got to bump that up to $15.49 a month for the standard plan. And they have a premium plan as well.
All right. Netflix sitting at a market cap here, let's call it $212 billion. It's up about 0.4% today, up 61% year to date, and on a trailing 12-month basis, the stock is up 136%. And again, kind of the questions from a lot of analysts are going to be these new revenue drivers. Are they going to be enough to continue this growth story? More Bloomberg Markets starts right now.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Coming up in this hour, we're going to break it down. We're going to get the latest on the stocks, what's happening in the market. Then we're going to go over to the UK. Pooja Kumra, European rate strategist with TD, that's Toronto Dominion Bank, joins us to talk about the UK CPI coming in lower than anticipated. What does that mean for UK and core euro area inflation? And then Netflix, again, coming out with earnings after the close. We're going to break it down with the expert Geetha Ranganathan, U.S. media analyst with Bloomberg Intelligence. We'll see what the drivers are for our good friends at Netflix. But first, let's kick it all off with John Tucker.
And right now, the major averages in the U.S. all in the green. Risk-on rally in the markets today. Despite disappointing quarterly results from Goldman, U.S. bank shares largely spared from the losses after some solid bank earnings earlier this week. Now, investors have latched onto the idea, you just mentioned it, Paul, that inflation may be under control. That follows that better-than-expected UK inflation report that we got this morning. And George Bory at Allspring Global among those that think yields may have peaked.
Bond yields can trend lower over time, and we think we're at a point in time where, as we've seen a cool down in inflation. Growth has remained much stronger than people expect.
And U.S. equities, they're heading for their fifth consecutive monthly gain at this point. The S&P 500, 19 points higher. That's up 0.4%. We're at 45.74. The Dow Jones Industrial Average, despite having Goldman Sachs in the index, up 186 points. That's a rise of 0.5% today. We're at 35,140. The S&P 500 right now, the NASDAQ 100, that is, up 56 points. That is up 0.4%. And traders, again, looking ahead to earnings from names including Tesla and Netflix. We're going to get that after the close of regular trading in New York today. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Madison and Paul.
All right, John Tucker, thank you so much. We appreciate that. As always, Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio and streaming live on that thing called YouTube. Head over to YouTube and search Bloomberg Global News, and you'll get us live video. How cool is that? Right now, let's get a look at these markets here. Again, as John was just reporting, we got green across the screen here. Let's check in with Alexandra Semenova. She covers all this stuff for a Bloomberg News equities reporter. Alexandra, what are you looking at?
So I think that the focus today is on the big banks and, of course, on tech as always. But there's an interesting name that I'm looking at today. That's AT&T, up about 8% today. It's experiencing a bit of a rebound rally after selling off yesterday following a report from the Wall Street Journal alleging that companies, including Verizon and AT&T, have left cables coated in lead, contaminating parts of the country. Yesterday,
I had never heard of this before yesterday.
Apparently it was a big deal because it did prompt a wave of analyst downgrades and sent the stock to a 30-year low yesterday. So that move today, 8%, it looks good, but it doesn't look that good when you look at the full week. AT&T, however, did come out today and it addressed those allegations, saying that less than 10% of its cables are coated in lead. That was favorable among analysts. TD Cowen today said that the company provided a compelling response to those allegations, and Barclays said that the impact on the stock had seemed overdone. So being met positively today at addressing those concerns rather than kind of brushing them off.
Man, that is, I was talking to John Butler, who covers these telecom stocks for Bloomberg Intelligence. I don't know where you make a compelling case to own, like Verizon. I mean, all the businesses, those, the wireline and the wireless business, mature businesses, competitive price cutting. You got the cable companies out there for broadband. I don't know where you go as an investment theme there.
Well, what would you have done back in the day, Paul?
I wouldn't be recommending them.
You'd just be like, I'm out.
Yeah. Put the gentleman hold on there. So in case any investment banking business wants to come our way, we're not going to get the nook. But yeah, I can't see how you make a case there. Same is true for the cable names. You talk to some of the smart cable folks out there. Again, kind of a tough story out there. So at least a good day for AT&T today.
Yeah, and a good day for the top 7 stocks, as always. Alex, can you talk to me a little bit about what might be the catalyst for some expansion beyond those top 7 names?
Yeah, so an incredible run in those names, the Super 7, the Magnificent 7 is what everyone is calling them. Think Apple, Microsoft, Alphabet. They've averaged a 98.6% return in 2023, led, of course, by NVIDIA's 211% rally. And, of course, investors have been really concerned about the narrow market leadership. And it's justifiable when you look back at the 2000 dot-com bubble, kind of bringing back some, concern around how this might end up. But history suggests that periods of this type of extreme concentration are usually followed by outperformance in some laggards that could trigger a mean reversion. Bank of America Corp has been one of the banks that has been saying that they see opportunities expanding beyond the Magnificent 7. They've hammered down on their call that the S&P 500 equal-weighted index looks set to outperform the S&P 500, citing concentration risk, valuation discount, duration risk, and room for upside based on bottom-up analyst price targets. Credit Suisse also said yesterday that it expects the median company to deliver strong returns than the cap-weighted benchmark. So, of course, the concentration itself is the catalyst because these Magnificent 7 stocks are trading at 40 times earnings. You look at the other names, they're trading at about 15 times earnings. So there's a lot of opportunity there for investors to play this top-heavy market and perhaps look at some names that have been kind of neglected, and we could see that.
Yeah, I love that reporting that nugget you just threw out. I mean, if you take out the Magnificent 7, the S&P 500 is at 15 times earnings. I'll buy that all day long, presumably. So I guess it's one of those things that sometimes you hear portfolio managers say it's a stock picker's market. So if you take out the big 7, you try to find some good names that are trading good valuations. Interesting.
Yeah. And you've talked to Alex about how the earnings season is not necessarily going to be as much of a headwind when it comes to markets as maybe some of us have anticipated. I feel like we keep every earnings season, we talk about how we're in an earnings recession, and then you get a bunch of beats when it comes to the actual earnings. So what is your takeaway on that, and what are your sources telling you as to how to kind of digest this earnings season?
Yeah, so it seems, of course, markets are forward-looking, so it seems that investors have already priced in the worst of these earnings recession warnings that we've gotten. Everyone is worried that profits could fall for 4 consecutive quarters, which would be, the worst of earnings pain since 2020 when the pandemic happened and multinational companies were experiencing supply chain issues, a big setback in profits, a stronger dollar. But the worst is mostly over when you look ahead to companies. And of course, AI is playing a big role also in driving earnings, even though we are talking about how some of the other names outside of the Magnificent 7 companies are the ones that you kind of should seek opportunities out in. The big 7 companies are still the ones that are reporting the strongest earnings results, and they have those healthy balance sheets. The investors are piling in. Even if a recession does happen, they're the names that people kind of want to be in on because they have dependable revenue streams, and they're kind of the strongest ones.
A lot of analysts or just fund managers, strategists who come in here and say there's still earnings risk to this market. I'm looking at the S&P 500. The earnings estimate for this year is like $220 roughly. It's kind of flat with the year before. But some people come in here and say it could be 200 or 180. I'm like, I'm just not seeing that. And I'm not sure. I mean, we are in the midpoint of the year. I don't see it. It feels like the earnings risk in this market isn't that great, but we'll have to see how it plays out, I guess, throughout this quarter.
Yeah, I have to mention Trivariate Research. Adam Parker over there has some brilliant reports out on this earnings season. He was the former chief U.S. equity strategist at Morgan Stanley for many years before starting his own firm, and he made an interesting point. The bear case is as low as $180, and he says that it's just basically impossible for that to play out. And the removal of the base case is the reason that multiples are going higher, is that we're just not seeing the worst case scenario play out, and that's driving the market.
We should get him on.
I'm typing right now to Eric. Thank you for bringing that up.
He's terrific.
I'm typing it right now in the IB, so you can just talk for a little bit while I do it.
That's great. We should definitely get him on. And Alex, I know that you spend a lot of time talking to your sources about kind of what we might be missing when it comes to markets because we're just so in the weeds of it all day, and you get the big picture look. Is there anything else that is top of mind for you today or this week when it comes to the trade?
I think in general, look out for what happens in the fall, right? Going into the summer, everyone was kind of worried about the impact of the Fed's skip, what would happen with CPI. There were a lot of headwinds that investors were worried about, and some portfolio managers that I spoke to said that the fall is, when the time will be when, if this rally continues, if investors are still sitting on cash, they're going to be, clients are going to be saying, why aren't we getting some of these juicy returns from the stock market? So that's when we're going to see the FOMO rally really kick in, is in the fall, once we get past these uncertain summer months. And look, the rally is still going. What was it, 45.74 today on the S&P 500? I mean, that is just incredible. The consensus price, year-end price target was at 40.91. So stocks have just blown past that.
All right, Alexander, thanks so much. As always, Alexander Semenova covering all the equity markets for us. We appreciate that. Good stuff. All right, let's talk about the rates here. We had some inflation data came out way early this morning out of the UK. Still very high, but below expectations. So maybe starting a positive trend there. And we're seeing movement, obviously, in currencies and in rates as well. But let's check in with Pooja Kumra. She's a European rate strategist at TD. Pooja, what did you make of the UK economic data, the inflation data that came out today?
Good morning. Yes, never a dull moment in UK. I think for the first time since February, the inflation did surprise to the downside, and I think this has come as a big relief for the hawkish expectations that were actually playing out in UK. And right now, markets have actually moved the terminal expectations from close to 6.5 that we saw a month ago to actually 5.75, which seems much more reasonable. But as you say, inflation in UK is still very elevated. Food inflation is almost thrice the levels that we see in US. So I think we do have a long way to go, but on the positive side, going forward, the base effects, both in energy and good prices, should actually allow UK inflation to actually be more correlated to what we are seeing in UK and in Europe. And we do see inflation to end the year around the 4 to 5% level, which is a big relief for BOE as well as Rishi Sunak.
You mentioned the cost of food, and I wonder to what extent your average, I'm going to steal this from Paul, the watering hole attendees of the UK are able to feel any sort of decrease in the inflation numbers when they're still going out to get the same meal they would have gotten a year ago, and it's so much more expensive. Do you have a take on when the consumer in the UK might start to be able to feel any sort of decline to the red-hot inflation they've been experiencing?
Yes, I mean, last 6 months have been pretty much high prices everywhere, but we are actually seeing prices going down when we go to all the supermarket as well as grocery stores. There, we are actually getting emails from all the grocery chains that they are actually reducing prices. So I think there is some government pressure also involved. And also one of the key things that the government as well as the BOE is aware of is that we are going to get very big mortgage payments as we enter towards the end of the year and 2024. So household buffer is actually going to be more compressed. And it's going to be a slow mover, but definitely we are moving in the right direction. And that should be a good news for UK. And that's why the 20 basis points rally in today's session.
So, Pooja, as you talk to your institutional clients around the world, and you're talking to them about the European rates business, what's kind of the most common trade that you're hearing people, I guess, are most interested in right now?
So right now, I think the US CPI as well as the UK CPI have actually told us one thing, that we are done with this entire hiking story. 1 or 2 hikes, most central banks are done. And the key thing is how long we stay here. From a trading perspective, we like long duration, and I think that is something even investors are looking at. But I think after today's UK CPI report, one of the key trades that I like is being long UK versus bonds, just given the fact that I think euro has rallied quite a bit when inflation will be equally sticky in Europe as compared to in UK as well.
Are you thinking about currency quite a bit then in your calculations?
When it comes to the general strong pound, or as in?
Yeah, the strong pound, and I guess particularly as we're starting to see the decline of the US dollar hitting a 14-month low last week. Is that something that you think is going to be potentially a tail or headwind for you this year?
I think generally now it's the Fed's show, just because the fact that so far what we had saw that UK was just not correlated with the moves in US as well as in Europe, just because we had the strength of inflation, and BOE actually had to come up more hawkish as well as hawk 50 basis points when most of the central banks are actually at their terminal. But I think that pound strength should actually be a little more muted, and we should now be more driven by where Fed takes it from here, whether it's one hike or two hikes going forward. And I think that would be key when it comes to messaging going into next week's Fed meeting.
And Pooja, to what extent, just give us a kind of little bit of a tutorial here, to what extent does the Bank of England and the European Central Bank, to what extent do they follow the U.S. Federal Reserve?
Well, to quote unquote, at least on the central bank meetings, we are told that we are different. We have different economic background to handle with. But I think Fed is one central bank that basically determines interest rate for the entire world. So I think one way or the other, when Fed actually decides to stop, it would actually mean that the other central banks also need to do less. So I think, yes, Fed still plays a very key role when it comes to where terminal comes for most central banks.
So, and we think that next week the Fed is, it seems like a foregone conclusion here in the States, a 25 basis point hike. When you look ahead to August for the ECB, is it going to be maybe down to 25 basis points after this inflation print?
So when it comes to ECB, they've already told us that they will be doing a 25 basis points in July. I think the key question is whether they go 25 again in September. I think at this stage, they would like to maintain the optionality, but we have had hawks even coming in this week saying that there's no need to press that much on terminal. So I think it is very much possible that we are done with one hike, but I think central banks right now, including Fed, wants to keep the optionality for going in September as well. And I think the key driver right now will be the August Jackson Hole meeting. I think that would be the next stage where central banks give us the key insight into what they are thinking for the September meeting. I think right now all central banks want a little more data to convince themselves whether it's one or two hikes and they're done.
Hey, Pooja, thanks so much for joining us. Really appreciate getting your perspective, the European call there, the UK call on rates. Pooja Kumra, European rate strategist at TD. So again, the good news, I guess, coming out of this inflation print out of the UK is it's peaked and showing signs of seriously turning down. But boy, it's still significantly higher than the U.S., and that's got to be tough. So that, if the Bank of England, one, maybe two, you can't be off the table in terms of rate increases here.
Yeah, just still being around that 8% number. It's we weren't there.
We were there for 15 minutes.
A year ago. Yeah, I mean,
we were over about 9.1% back in June of last year, and then kind of really coming down sharply here in the U.S. Hopefully, our good friends in the U.K. and Europe can have a similar experience. Looking at the rates here, just in the U.S., pretty much unched here. The 10-year Treasury, 3.77%, the 2-year at 4.77%. So 100 basis points inversion. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Microsoft is offering a free cloud security log for all customers in the next few months. That decision comes after suspected Chinese hackers infiltrated cloud-based email systems at about 24 organizations worldwide, including U.S. agencies. More on Microsoft and its stalled acquisition with Activision Blizzard. The companies extended their deadline to join forces in the biggest ever video game deal. Bloomberg's Gina Cervetti reports.
Steve, Activision Blizzard agreed to give Microsoft 3 more months to close their $69 billion merger so the companies can iron out remaining regulatory concerns. The agreement was set to expire last night at 11:59 Pacific time. Now the companies will have until October 18th to get it done, according to a regulatory filing. The parties also increased the amount of a breakup fee Microsoft will pay to Activision if either side terminates the deal, but both have said they don't plan to walk away and will continue to seek regulatory approval. Steve?
Thanks, Gina. Shares of Microsoft and Activision Blizzard are currently down less than 1%. It was far from a golden quarter for Goldman Sachs. The firm reporting Q2 earnings fell 58%, or profits rather, fell 58% on an investment banking slump. CEO David Solomon, though, sees better days ahead.
Our results were impacted by several items related to businesses we're executing on a strategic transition and positioning the firm for the future. In particular, shifting our asset and wealth management business to a less capital-intensive model and the pivot to narrow our consumer ambition.
Solomon was on a call with analysts. The company had been tamping down expectations for days ahead of the report. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. The major stock averages adding to their gains, and this despite the disappointing earnings from Goldman Sachs. Now, it was down earlier, one of the biggest drags in the Dow Jones Industrial Average. Goldman Sachs right now is up 1.9%. In the S&P 500, 9 of the 11 major indices groups in the green. Real estate was leading the way. You had data this morning. Paul, you guys talked about that a little earlier. UK inflation slowing, so that's led to the idea that rates globally may have peaked, adding to risk-on sentiment. Apple, among the most actively traded stocks, the company quietly working on artificial intelligence tools, could challenge OpenAI, Alphabet's Google, as well as others in that space. Right now, the S&P 500, 13 points higher. That's up 0.3%. 45.68 on the index. The Dow Jones Industrial Average up 143 points, and that is a rise of 0.4%. The Nasdaq 100, 20 points higher, up 0.1% right now. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Madison and Paul.
All right, John Tucker, you got that right. John Tucker with that Bloomberg Business Flash. We appreciate it. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Brokers studio. Madison, don't tell anybody, but my favorite BI analyst is Geetha Ranganathan.
I have a feeling because she's my favorite as well.
Yeah, Geetha. So. She covers the U.S. media business for Bloomberg Intelligence. Hey, Geetha, we got Netflix after the close. Stocks at a 52-week high today. Boy, I didn't see that coming. What are you going to be looking for here when we hear from the company?
Yeah, Paul, lots of things to really look for. So one is obviously the first number that everybody is interested in, which is their subscriber number. Estimates have been slowly but surely building for that number as they have two major initiatives in place. One is, the password crackdown, and this is the first quarter after, their widespread password sharing crackdown that they implemented in the U.S. across 100 markets across the world. Plus, they have launched an advertising-based plan sometime late last year. So again, both of those in combination are expected to boost both subscriber numbers as well as revenue numbers. So again, those are the two main things that we're looking for. And then of course, third quarter guidance. So they don't provide subscriber guidance per se, but we're all going to be looking for the revenue number that they're guiding to, the revenue growth number. So far, it's been pretty tepid. In 2023, it's been about 3 to 4%. We're expecting a major ramp up going into the third quarter.
So basically, it sounds like little to no chance of a ding when it comes to user numbers because of the password crackdown. Is that right?
So what has happened is after they rolled out what they had initially said in their first quarter earnings calls, the last earnings call was that they were going to implement this, and they actually expected a lot of cancellation activity. So they said, be prepared for a lot of short-term noise. There's going to be a lot of churn because that's how, the Canadian market had kind of behaved. But when we kind of tracked some intra-quarter, or when we got some data from the third-party tracking services for these intra-second quarter updates, we actually did not see any of that highly anticipated churn activity, which means that, there was, of course, an uptick in new subscriber gains, but there wasn't necessarily too much of cancellations. So we think that should obviously boost the subscriber numbers. But I think one of the things that people are, fearing is that there's almost the bar is almost too high at this point because expectations have been building, and it is possible, as funny as it might seem, it's possible that with the whisper number being as high as it is, it's about 4 or 5 million, that Netflix might actually disappoint.
Wow. Okay. All right. So that's Netflix. That's the good story. The rest of your space is disaster, Geetha. I mean, the media space. I think about Walt Disney Company, Warner Brothers Discovery, Paramount. Do investors? Does anybody pick up your phone call when you call to talk about these stocks, or people are just saying, I got to wait and see how this all plays out, this transition to streaming and the economics of it? Where are we?
Unfortunately, Paul, you're absolutely right. The headwinds in the linear media space or the old media space has just gone from bad to worse. So we've had cord cutting, which traditionally used to be like a trickle, but now it's kind of become this deluge, right? So it was 4 or 5% of video subscriber declines. This year we're averaging about 11%. So again, there's absolutely no doubt that the linear TV model is on the verge of collapse, and that was almost publicly acknowledged by Bob Iger just a few days ago. So definitely I guess the sentiment is very, very negative. You add to that, the Hollywood strikes, the writer strike, the actors strike, and it's kind of almost this perfect storm for the media companies right now. So not looking too bright. I mean, content production, which is the lifeline of any media companies, obviously has come to a complete standstill. It's going to be really, really hard because advertising, we're looking at linear ad declines of anywhere from 15 to 20% for the second quarter.
Oh,
yes.
Boy.
So it is bad. And then if you don't have any new programming coming, it's going to get only worse. Right now, really dire.
All right, you're out with a good piece of research yesterday on the Disney company, I think following up probably on Bob Iger's comments about the linear TV business. And you put some valuation work out there, what this thing could be worth. So tell us about, what TV networks you're talking about at Disney and what could be the value.
So it's all of the TV networks other than ESPN. So Bob Iger definitely sees a lot of strategic value in ESPN. He has said it's not a question of if, it's only a question of when we take ESPN completely over the top. So we're expecting that happens sometime in 2025. And he actually talked about, looking for strategic partners to do something further with ESPN. So the assets that they are calling their non-core assets are all the other assets. So they had actually acquired some of TV networks with the Fox acquisition. So think of FX or National Geographic. And then of course Star in India, which was this huge bright spot and was supposed to bring them so many millions, hundreds of millions of subscribers, but has just kind of underperformed tremendously lately. So they're actually looking to dispose of all those assets. And yes, we did do some valuation work. We think that it could fetch anywhere from about 19 to 23 billion just based off of comparable multiples for the rest of the media peers.
Specifically on Disney, I was just curious about Bob Iger's comments about the protests with actors calling their demands unrealistic. Is the writer's strike, is the actor's strike going to have any tangible market impact on the Disneys, on the Paramounts, or is this kind of just a drop in the bucket for them?
So it really depends on how long these strikes kind of last. So if it's, 3, 4, or even 5, 6 months, if it's through the end of this year, I think the media companies can manage. They've done it before. They've done it through COVID. The thing is, if it spills into 2024, then we have a real problem on our hands. I mean, even if you're looking at the fall schedule for 2023, it's obviously looking pretty light. So that could be a problem. But on the flip side, it also helps boost their profitability because now they're not kind of spending all of that money on content. So it does something for their bottom line, which is actually good given just the intense scrutiny and the focus on profitability. But longer term, it is definitely a huge problem. I mean, some resolution has to happen sooner rather than later.
Right. Paramount, I got to go there. There's a lot of chatter out there that this company remains subscale in terms of size, and that maybe it is a sale candidate, even though there is a control shareholder in Sherry Redstone and her family trust there. But it's got a market cap of only $10.5 billion, just a shadow of its former self. What do you think Sherry wants to do with this company? Would she sell it? Who could buy it? What do you think happens to Paramount?
She definitely wants to sell it, but I think she has to sell it in pieces. And I don't think anybody necessarily wants to buy the whole company right now. That might be the problem, the biggest problem for Paramount. So how they kind of approach the sale process, I think she would definitely be courting any tech company, be it an Amazon, an Apple, a Google. They all are great candidates. Paramount has, if you just look at the studio, they have a fantastic library. It's an iconic studio, and we think that just based on comparable multiples, like if you look at the Amazon MGM deal, this library is so valuable. It should trade at or it should sell for about $25 to $30 billion. So obviously they have some really, really valuable assets. How they're going to structure that, because again, will anybody really want to buy the whole linear TV portion of it? The studio is extremely valuable. We know that. Pluto is valuable. Paramount Plus, the streaming platform, could be valuable. But then what do they do with the linear TV portion of it, which actually brings in about 50% of their revenue? So that is really the big question mark. And it's a question mark not just for Paramount, Paul, but even for Disney, even for Warner Brothers, for all of them. Like, who is a ready buyer of these assets?
Is private equity, I mean, they're always my buyer of last resort for everything. And these are good cash flowing businesses. Maybe that's a play.
Yeah, no, that has, that definitely has come up. Maybe they do kind of come in. We've seen them become more and more active, definitely in the TV broadcasting space. Again, a highly cash flow generative business, even in the cable space. So yeah, again, something to wait and watch.
All right, Geetha, thank you very much. I know you'll be working through the evening here. Netflix reports after the close. That's always fun. Take a couple hours after the conference call to then write your note and get all that kind of stuff up. But that's the life of a sell-side research analyst. Geetha Ranganathan, thanks so much for joining us. U.S. media analyst from Bloomberg Intelligence, joining us from our Bloomberg Princeton campus studio.
We got to get over there, Paul.
Yeah, I spent a lot of time there. It's great people, great facilities, big solar field out back. So they just power the whole thing.
I've never been.
Great food, breakfast and lunch.
Are you serious?
Yeah.
Oh,
it's in the middle of nowhere.
I'm transferring offices.
It's awesome.
Yeah, I need to go.
It's good, particularly if you live down in that area.
Yeah.
And you have to come into the city. So that's where we started. That's where a lot of our BI folks still reside. S&P 500, give them back a little bit here. Still up about 0.2%, but off of the highs, intraday highs for the day. Right now, let's head down to Washington, D.C. Nathan Hager's got world and national news for us.
Yeah, save me some room at that pantry. Thank you, guys. Israeli President Isaac Herzog is trying to reassure U.S. lawmakers about the state of democracy in his country. He's been speaking to Congress today, acknowledging intense and painful debate over Israeli Prime Minister Benjamin Netanyahu's hardline government. There have been protests raging for months in Israel over moves to weaken the judiciary and to expand Jewish settlement in the occupied West Bank. Herzog is in Washington officially to mark Israel's 75th anniversary. Russia's defense ministry says all ships headed to Ukraine's ports will be considered as potentially carrying military cargo as of tomorrow. That announcement could raise military risks in the region and crush even vague hopes of Ukraine resuming grain exports. Meanwhile, explosions ripped through a military base today in Russian-occupied Crimea. That was hours after Russia targeted the port city of Odessa with a barrage of missile and drone strikes. Hazing accusations at Northwestern University now have the attention of civil rights attorney Ben Crump.
It is a toxic culture that was rampant in the athletic department at Northwestern University.
Ben Crump says his firm and others are representing 15 people and have been in contact with dozens more former baseball, softball, and football players at Northwestern. He says they have yet to file any lawsuits, but the complaints are growing. A country music controversy. Country Music Television has pulled the video for this song by Jason Aldean. It was filmed in front of a Tennessee courthouse where a lynching took place in the 1920s. Democratic State Representative Justin Jones of Tennessee condemned the song and the video on Twitter. The New York Times reports Aldean says the idea his song or video are pro-lynching is meritless and dangerous. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. The Dow, the S&P higher, NASDAQ just turning lower. 5-point drop right there. We do check markets all day long here at Bloomberg. For the most part, those stocks are higher as investors cheer cooling inflation in the United Kingdom. They're also looking ahead to tech earnings due at the close of New York trading. Right now, we have got the S&P up 7, gain there of 0.2%. The Dow up 98, higher by about 0.3%. NASDAQ in the red, down 4 points now, little change. And we've got the 10-year yielding 3.75% with the 2-year 4.75%. Spot gold down $2.50 the ounce to $19.75. Drop there of 0.1%. West Texas Intermediate crude 75.87 a barrel for crude. That is a gain now of just about 0.2%. Goldman Sachs shares higher. They initially were lower at the open, but Goldman Sachs profit plunged as the Wall Street giant notched one of its weakest quarters under CEO David Solomon. Goldman up now by 1.4%. Allison Williams is a senior bank analyst with Bloomberg Intelligence, and she was interviewed this morning on Bloomberg Surveillance.
They've been a good acquirer in their asset management business, but not a great track record elsewhere. The consumer business, sort of putting that strategy behind them with a slight gain that's an offset. And then these commercial real estate write-downs, which sort of validate and show you why they are shifting more towards a model where the risk is not going to be on their balance sheet, but it's going to be in funds.
And again, Goldman shares up 1.5%. You can hear more of the conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Tesla among the names reporting after the close of trading today. Tesla up now by just about 0.2%. Netflix also will be closely watched after the close of trading. Little change right now, up by less than 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pello, thank you so much. We appreciate Madison Mills. Paul Sweeney here in our Bloomberg Interactive Broker Studio. So, Madison, back in my sell-side research days, you'd have to schlep out to San Francisco 2 or 3 times a year to see institutional investor clients out there. Love that town, still one of my faves. But then you'd have to go, not downtown, you have to go schlep all the way out to San Mateo to see these Franklin Templeton people. Now, it wasn't a bad trip because they have a great Starbucks right there. But nice people, smart people, and they manage a bunch of money. So I've still got some buddies out there from back in the day. Ed Perks, he's out there in San Mateo. He's the CIO of Franklin Templeton Income Investors. Ed, I mean, you got fixed income folks had a brutal 2022. There was just nowhere to hide. Off to a little bit better start this year. How are you guys positioned out there with some of your fixed income, kind of asset allocations in your performance?
Yeah, absolutely. You're right. 2022 was a tremendous challenge for fixed income investors. I think the key element for us, for Franklin Income Investors, is multi-asset flexibility. So really at no other time in my career, really, have I seen this play out in a 6 to 8 quarter way where we entered 2022 with a very strong bias and tilt in our multi-asset portfolios towards dividend-paying common stocks. And that was really just reflecting the landscape and the opportunity set entering last year. 10-year rates were, I think we were down near 1.25 still, 1.25, 1.5%, and you just didn't have enough spread. And the key things that we look to fixed income for in our portfolios: attractive yield, potential for some upside, or potential to help diversify our portfolio. And I tell you, most of 2022, particularly the start of the year, we couldn't check any of those boxes. So we've come full circle, though. And today we sit from a tilt of nearly 75-25 in favor of equities 8 to 12 quarters ago to now better than 60-40 tilting to fixed income. So that landscape has totally changed. And yes, you are seeing it, whether you look at broader aggregate bond market returns, investment grade corporate returns, high yield corporate returns, all doing much better. A little paling in comparison to something like the NASDAQ move, but I think fixed income investors have a lot to look forward to.
Well, okay, since you brought up the NASDAQ move, I just have to ask you about this. We saw the NASDAQ dip into the red a couple of minutes ago because of some moves that we're seeing in the big tech names, the Microsofts, the Googles. It feels like the perfect example of why it's a challenge when you have this breadth of names leading the charge when it comes to these indices. Is that a concern for you that you think about in terms of your allocation into equities?
You know, it as it relates to the NASDAQ in particular, given we're income investors, we really aren't too concerned about, some of those moves or the narrowness of the leadership. I know that's been well discussed in markets here the last couple of months. We're really focused on this kind of broader move. So we clearly point more to, the S&P 500, both the difference we've seen, the dispersion we've seen year to date between something like the market cap weighted index and the equal weighted index. That's starting to perform a little bit better. But we wouldn't be surprised if there's a pretty significant breather here in equity markets. And, we are going to see, we'll see even with companies reporting slightly better earnings, we're still looking at likely flat to slightly negative year-over-year earnings. And that's something that, we think as you look forward into the end of 23 and particularly into 2024, this bar, the hurdle really starts to rise because consensus really bakes in a resurgence in growth in Q4 and then into 2024. And we just think that may be a little premature. We're still looking at a pretty modest level of GDP growth. We're seeing disinflation. We think a lot of companies have actually had a bit more of a struggle with unit volumes, but have had tremendous pricing. That's going to start to wane and certainly become much tougher with comps. So, we wouldn't be surprised if the remainder of this year might tilt a little bit more to some of the fixed income markets and equities have some digesting to do of this very big move they've had.
Hey, Ed, in the fixed income space, as income investors, where are you guys kind of putting your money to work? Where have you been putting your money to work this year?
Yeah, we've really focused on some of the higher quality segments within investment grade corporates, and that's a big difference from last year where we started with much shorter duration. We're very selective, actually liked high yield bonds. We didn't see the economy completely cratering, and in high yield you can find some really interesting opportunities with very minimal interest rate risk. As rates move, first into the fall last year, then this spring before the regional banking crisis, and then more recently we've had opportunities with the 10-year in and around 4% through that level a couple of times, and spreads, while not maybe as wide as a lot of credit investors would ideally like to see, you had yields at levels that we haven't seen in a while. You had bond prices because of last year's decimation at much more attractive discounts to face. And like I said before, you want to check some of these boxes in fixed income today, particularly higher quality investment grade corporates. You now have that opportunity. Income's attractive. Total return possibilities are there as we think rates do decline over the next 4 to 6 quarters. And they're nice diversification again in a multi-asset portfolio.
Right. Hey, Ed, why don't you in your lunch break hop down on the 101, go a little bit south to Cupertino, see our friends there that make cell phones, and tell them to step up and pay a real dividend. Does that frustrate you as an income investor that you got a company with $1 gajillion of cash on the balance sheet, $100 billion of free cash flow every year, and they pay a dividend yield less than 1%?
Yeah, you're preaching to the choir. We certainly are strong advocates of that. We think it just makes sound sense. It broadens your investor base, and there are certainly other things that we can do with using convertible securities, for example, in our portfolios, or other structured equity like investments where you're kind of effectively doing some covered call writing and getting some premium. So we do have some opportunity in lower dividend paying or non-dividend paying stocks, but absolutely would firmly agree with you there.
All right. If you see him, Tim Cook around the neighborhood, maybe put that in his ear. Ed Perks, CIO, Franklin Income Investors out in San Mateo, giving us some good discussion on income investing, fixed income, preferred stock, as Ed was talking about, common stock with some big dividend yields. Certainly a lot of ways to get generating a fund that really is focused on income.
Yeah, it's important to look at, particularly as the Fed starts to near the end of their rate hiking cycle, how that's going to impact the fixed income space as well.
All right, S&P 500 up 0.2%. The NASDAQ kind of flattish here, so kind of giving it back a little bit. We're going to have more coming up. This is Bloomberg. Get some company news right now with Steve Rappaport.
Paul, let's talk more about Apple. The company is reportedly picking up the pace in the AI race, working on tools that would challenge those of OpenAI, Google's Alphabet, and others. Sources tell us Apple has built its own framework to create large language models. Those models are at the heart of programs like ChatGPT. Shares of Apple currently up less than 1%. Tesla stock is up ahead of reporting second quarter earnings after the bell. Data compiled by Bloomberg estimates its automotive gross margin will come in at 20%, down from about 28% from the same period last year. Bloomberg's Jeff Bellinger reports.
Bloomberg Intelligence says the company can no longer blame delivery declines on capacity constraints. Any drop-off in demand will have resulted from economic conditions, competitors' EV efforts, a lack of new products, and a self-inflicted tarnishing of Tesla's image. Trimming aggressive growth targets is not in Tesla's playbook, and the company may continue its effort to solidify market share at the expense of profits.
Thanks, Jeff. Goldman Sachs reports profits took a beating in the second quarter, down 58%. Bloomberg's Sonali Basak with more on that.
Everyone's calling it the kitchen sink quarter. This was a little bit expected here, but these write-downs are significant. Without them, they would have had an ROE north of 9%. But because they are here, it is worth addressing whether we'll see these kinds of losses again. Some of the consumer business won't take the same kinds of losses. This now becomes a story of what does the second half of the year look like.
Thanks, Sonali. Goldman's rate of return slid to 4%, the worst among the top U.S. banks. Shares of Goldman right now are currently up 1.46%. I'm Steve Rappaport, and this is Bloomberg.